Thank you, Christian. Good afternoon. Welcome to HealthEquity's fiscal year 2021 Sales Metrics Conference Call. My name is Richard Putnam, do Investor Relations here for HealthEquity. Joining me today is John Kessler, President and CEO, Dr. Steve Neeleman, Vice Chair and Founder of the company, Darcy Mott, the company's Executive Vice President and CFO, Tyson Murdock, Executive Vice President and Deputy CFO, and Ted Bloomberg, our Executive Vice President and Chief Operating Officer. Before I turn the call over to John, I have two important reminders. First, a press release announcing our sales metrics for FY21 was issued after the market closed this afternoon. The metrics reported in the press release include the contributions from our wholly owned subsidiary WageWorks and accounts it administers. The press release also includes definitions of certain non-GAAP financial measures that we will reference today. A copy of today's press release, including reconciliations of these non-GAAP measures with comparable GAAP measures, and a recording of the webcast can be found on our investor relations website, which is ir.healthequity.com. Second, our comments and responses to your question today reflect management's view as of today, February 8th, 2021, and will contain forward-looking statements as defined by the SEC, including predictions, expectations, estimates, or other information that might be considered forward-looking. There are many important factors relating to our business which could affect these forward-looking statements made today, and these forward-looking statements are subject to risk and uncertainties that may cause the actual results to differ materially from the statements made here today. As a result, we caution you against placing undue reliance on these forward-looking statements. We also encourage you to review the discussion of these factors and other risks that may affect our future results or the market price of our stock, which are detailed in our latest annual report on Form 10-K and in subsequent periodic reports filed with the SEC. We assume no obligation to revise or update these forward-looking statements in light of new information or future events. And at the conclusion of our prepared remarks, we'll turn the call over to our operator to provide instructions and to host our Q&A. With that out of the way, I'll turn the mic over to our CEO, John Kessler.
Thanks, Richard, and thanks everyone for joining us today. I will talk about the FY21 sales results. Ted will describe our plan to beat them in fiscal 22, and then Tyson is going to update FY21 guidance and offer a first look at FY22 based on the results we're reporting today. Steve and Darcy will join us for the Q&A. So one thing that makes working at HealthEquity very special is the fact that our mission and our business are so well aligned. The team's ability to help our members connect health and wealth and successfully build health savings also fuels our long-term growth. Our members had a lot of success this past year in that regard. HealthEquity HSA members ended fiscal 21 with $14.3 billion in HSA assets, up 24% from a year ago and 26% on an organic basis. Organic asset growth, which excludes both gains and losses from the WageWorks acquisition and migration, increased from $1.8 billion in fiscal 20 to roughly $3 billion in 21. Even more exciting is the growth in average HSA balance, which grew by 15% in FY21, up from 7% in fiscal 20 and 2% in fiscal 19. The majority of that growth occurred from the result of sales and member engagement efforts throughout the year. What happened? First, our new members added more assets than ever before. HealthEquity ended fiscal 21 with 5.8 million HSA members, up 8% year over year and 11% excluding migration-related closures. That total includes 687,000 new HSA members added during the year, which is down from FY20's record 724,000. Almost all of that year-over-year gap occurred in the second and third quarters, during which new hiring by existing clients ground to a halt as a result of the pandemic. Q4, driven by open enrollment and new client wins, was much stronger. As Ted will describe in a bit more detail, these HSA wins included both cross-sell clients consolidating with HealthEquity atop an existing CDB relationship and new logos. The new HSA clients fed approximately $300 million in HSA transfers from other custodians in FY21, which was up 35% year over year, most of which occurred in January. Second, more of our members, both new and existing, learned the full power of an HSA, transitioning from spenders to savers and investors. The number of our HSA members who invest grew 51% year over year. 51%, that's a lot. The percentage of HSA members who invest reached 5.8% at fiscal year end compared to 4.1% a year ago. HSA invested assets grew 48% year over year, far outpacing stock or bond market gains. $4.2 billion in HSA invested assets now make up 29% of total HSA assets as of the fiscal year end. These are really positive trends for the long-term value of HealthEquity in our view, because more members using the full power of HSAs drive our profitability, and cross-sell and client takeaways spur outperformance atop a still growing HSA market. They speak to the return on our investment in integration to a total solution and single proprietary platform, which drives cross-sell, and in the engagement and the engagement infrastructure and capabilities of that proprietary platform, which drive members to action. CDB enrollment was not so exciting, at least temporarily. At fiscal year end, HealthEquity managed 12.8 million total accounts, including the 5.8 million HSAs we've discussed, plus 7 million CDBs. HealthEquity sold and implemented new CDB accounts with nearly 1 million members in fiscal 2021. That's good, but CDBs in total still fell 0.4 million or 5% versus a year ago, and ex-commuter still grew by only 0.3 million or 4%. There are two reasons for this, both related to the pandemic. First, as I just mentioned, about 650,000 commuter accounts remain in suspense due to the continuing full-time work from home, and these are not included on our total accounts numbers. Second, we did not see significant office reopening in Q4. Second, a similar number of FSA members did not re-enroll for fiscal 21, and these include dependent care FSA members with temporary lack of access to or need for child care during work from home, and health FSA members who, perhaps at the time of enrollment, were still carrying significant 2020 balances due to interrupted health care access during the pandemic. Ted will talk about our opportunities to spur recovery in these areas in his remarks on our fiscal 22 opportunities. As information on the HSA market growth during this cycle comes around from various sources, we'll have more to say about our performance versus competitors and the market as a whole. So now let's look forward. While the pandemic remains with us, the HealthEquity team intends to beat the results I've just reviewed and to do so decisively, demonstrating the strategic value of the WageWorks integration and our total solution strategy. I'd like to turn the call over to Ted to discuss our plans to do that in fiscal 22. Ted.
Thanks, John. Good afternoon, everybody. Let me start with a message to all of our HealthEquity team members, clients, and partners. Thank you for all your contributions to fiscal 2021's sales achievements. My remarks will focus on the opportunity to accelerate our success in fiscal 2022. As you know, HealthEquity has multiple paths to growth. First, winning new network partner and employer client logos. Second, cross-selling more services to current clients via our total solution strategy. And third, growing employee adoption and use of HSAs and CDBs through engagement and education. Let's start with our network partners, which are health plans, retirement plan record keepers, and benefits administrators with whom we actively go to market. We grew the number of our network partners to 174 in fiscal 21, up from 165 1 year ago and 141 2 years ago. Beyond adding these partners, we improved the quality of the relationships. 12 of our partners added more HealthEquity services to their offering this year, showing optimism that our bundle strategy can help them serve their clients. We've also integrated more deeply with retirement plan partners, expanding our coverage from 25 to 35% of the defined contribution or DC market and achieving significant enterprise client wins together. Most importantly, for maintaining our purple culture, year-end partner satisfaction surveys earned nearly perfect scores from combined results across all types of network partners, despite a fair amount of platform migration-related activity this year. We believe that more happy partners offering more HealthEquity services will lead to more wins in fiscal 2022. Direct-to-employer and broker-driven new logo wins are also poised for fiscal 22 growth because last year's deferrals are this year's incremental opportunities. For enterprise employers, the pandemic made change more difficult this year, reducing the number of new enterprise RFPs market-wide and leading many to stall. But our talented enterprise sales team made the most of its opportunities, producing twice as many new HSA members in fiscal 21 as we did in fiscal 20. So we've proven we can win an outsized share of opportunities, and based on our early fiscal 22 pipeline and results, we believe demand is returning this year. Now let's talk about cross-sell, where, as you've heard John say, we see $400 million in revenue potential in our existing managed client base alone. Cross-sell was new to HealthEquity in fiscal 21, and yet we made a strong start. Over 50 of our largest early adopter managed clients added a new HealthEquity service to their benefits package this year. Now, with significant pieces of the go-forward platform in place and HSA migration substantially completed, we're poised for more. As fiscal 22 begins, the team is actively engaged in cross-sell discussions with roughly 20% of our managed client base. We are also beginning to scale cross-sell efforts into our small and medium employer client base, which unlocks further opportunity. Across both new logos and cross-selling, the sales and account executive teams are off to a great fiscal 22 start, with more business already closed than at this point last year. Finally, engagement, which increases the value of both new wins and current client relationships. As John discussed, we had our best year ever encouraging HSA members to grow their balances, and there is more room to run. For fiscal 22, our new Engage 360 hub is winning rave reviews as a source for education for members as well as for clients and partners. Also, we are expanding the Health Savings Score as a tool to target our efforts and inform clients' plan design decisions. One example of the power of making engagement and education core to our platform came during the first few days of January. A week after the most recent stimulus bill became law, HealthEquity delivered live and recorded education about what FSA and COBRA changes mean for employers, and we provided a streamlined process for them to take action. More than 5,000 employers and brokers engaged with our content, and nearly 2,000 employers have requested plan document changes to give their employees flexibility. This is part of the effort John mentioned to reactivate CDB members whose benefit utilization patterns were interrupted by the pandemic. We do not need to wait until next open enrollment season to make progress. In summary, we are well positioned to win new business, grow existing business, and help our members succeed by guiding them towards the right spending, saving, and investment decisions for their families. I will now turn the call over to Tyson Murdock. Tyson?
Thank you, Ted. Closing the books on fiscal 21 is underway, and the initial results allow us to update our guidance with the following for fiscal year ended January 31st, 2021. Revenue in the range of $729 to $733 million. Non-GAAP net income in the range of $125 to $128 million. Non-GAAP diluted EPS in the range of $1.67 to $1.71, and adjusted EBITDA in the range of $236 to $240 million. The revised guidance implies adjusted EBITDA margin for the full fiscal 21 between 32% and 33%. This is a remarkable achievement given the loss of high-margin commuter and interchange revenue and lower yields on HSA cash during fiscal 21. We will, of course, report final year-end results next month. Given the expected financial results for fiscal 21 and the sales results released today, we have sufficient confidence to provide early guidance for fiscal 22 revenue, which we expect to be in the range of $740 million to $750 million. I'd like to take a moment to describe key assumptions underlying this guidance, including those related to the unusual circumstances of the pandemic. With regard to commuter benefits and its impact on the service and card fees, our revenue guidance assumes that commuter will deliver less than half of its annual $75 million in pre-pandemic contribution revenue. With respect to healthcare spend and its impact on card fees, We assume that member spend will return to pre-pandemic levels within the first half of the year as vaccinations roll out and healthcare access is broadened. We have not, however, assumed a snapback in card spend or spending above pre-pandemic levels at this time. As Ted discussed, we have an opportunity to work first with employers and then with their employees to reactivate dependent and healthcare FSA enrollment depressed by the pandemic. As we are able to gauge traction, we will incorporate that into future guidance. Due to the stronger than expected HSA cash bill in January and the placement of those funds at current rates, which as you know are below our current average yield, today's guidance assumes a yield on HSA cash with yield for this next year to be at the low end of our previous yield guide, or about 175 basis points. The acceleration in seasonal January deposits beyond our expectation provides additional evidence that our members and employer clients understand the power of HSAs, and of course will provide additional benefit to HealthEquity as interest rates and interest rate policies begin to normalize. We expect adjusted EBITDA margins during fiscal 22 will be at comparable levels to today's upwardly revised guidance for fiscal 21, even with revenue outlook prudently accounting for the pandemic's persistence. We will report our Q4 earnings in the third week of March, and with more information in hand, look forward to providing additional outlook at that time. With that, I'll turn the call back over to John.
Nicely done. Tom Brady may not be passing the torch, but we're getting it done here. Thank you, Tyson. So for a long time, I'll just close with this. For a long time, we've predicted that using the full power of HSAs, that American families could eventually build roughly $1 trillion of health savings, and that seemed like a big number. But our vision and our mission and our values are all connected to that belief in that number. And our vision, which is that health savings will be as much a part of American families' saving strategies as 401ks and other retirement accounts are today, implies 50 to 60 million HSAs, and we think that's going to happen by 2030. And our mission, which is to be the best at helping HSA members build health savings, is about relentlessly driving all balances upward to, and we believe the end game on that is to the $15,000 to $20,000 balances that we see in our mature account cohorts today. And in fact, based on today's numbers, our investors, both new and longstanding, are on average already there, even though obviously their numbers have grown very quickly, and so we have a lot of new investors. So this is a long journey. It's a long journey to $1 trillion of assets being put towards healthcare security by the American public. But the path to that $1 trillion prediction gets clearer every time we report these sales results to you. Before going to questions, I want to join in the thanking, and in particular to thank those who are truly responsible for the results we're reporting today and driving health equity in our industry forward, which is not us, but rather our sales executives around the country, our marketing team, our sales support superstars, our hard Zooming account executives. They used to be hard traveling, now they're just hard Zooming. Service managers, implementation specialists, technology and operations, service delivery teams, and of course our member services specialists who welcome new members and really get them off on the right foot and just did a fantastic job this year in January. And a big thank you to our network partners, our health retirement benefit plan partners, as well as of course our employer clients for all they do to support their members in building health savings. It's really as a direct result of their efforts that HealthEquity closed fiscal 21 setting new highs for our number of network partners, our HSA members and assets, and really showing that we've got millions of families doing something positive about healthcare in America by building health savings. So with that, I will turn the call back to the operator and open for questions. Operator.
Ladies and gentlemen, if you have a question at this time, please press star, then the number 1 on your telephone keypad. If your question has been answered or you wish to remove yourself from the queue, please press the pound key. Again, that is star 1. Your first question is from Greg Peters from Raymond James. Your line is open.
Good afternoon. First question, just big picture question. The last several months we've seen some changing or some headwinds for the industry. I think the Allegis CEO stepped down. Webster's fourth quarter results weren't great. Connecture Care was sold. Can you give us sort of a perspective from where you sit on what's going on with some of your competitors that's resulting in the change, and what the headwinds are there?
Yeah, I mean, some of those maybe could be characterized as headwinds, some not. I think, without commenting on any specific competitor, Greg, and thank you for the question, that I'm surprised you're even available in Tampa. I would think you'd be out, partying and whatnot, but a little groggy maybe. But
I am definitely groggy.
All right, good. Groggy is good. But it's better than grunky. But I think that what you're seeing is is some consolidation of the industry based on the fact that succeeding in this industry takes capital. It takes talent, obviously, and it takes investment in both technical capabilities, but also in a technical ecosystem and connectivity. And for folks who are not able to make those investments or haven't made those investments, it's going to be challenging to continue to put up numbers. And and we're poised to try and take advantage of that. We've accumulated quite a bit of operating cash, and based on the numbers Tyson reported or guided towards, I expect that we'll grow that cash pile this quarter, and we have a ton of capacity out there. And so, we're going to be kind of focused on where those opportunities make sense for us on potential M&A and other kinds of transactions that really help us take advantage of that consolidation. And of course, then beyond that, we're going to beat competitors in the marketplace. And I think relative to what other competitors have put out there so far, our growth in terms of assets and accounts and whatnot feels pretty good, particularly on an organic basis. And but we'll see what others have to say as the industry reports. I guess I basically think the industry as a whole is not only alive and well, but it's doing what we said it would do, which was over time, right, accounts would mature and the asset component of those accounts would start growing and so forth. And over time, as we said, I'm back 6 years ago, I remember you were there, is that like all industries, the winners and losers would separate from each other, and I think we're a winner.
Yeah. So the other question I had was around, just account retention and network partners. Obviously, the results were challenged last year. I'm not looking at specific account retention. So I'm looking at employer retention, what your retention of your customers were, if that makes sense. And then on the new network partners, the hospitals, I think you said 174 versus 165 versus 141.
Yep.
And I'm just curious what the percentage of the HSAs relate to those. Is it an increasing percentage of your HSAs relate to those network partners? Is it a static number, or just trying to understand how that percentage is changing?
Yeah, I'll try and take the first part, and I'm not sure that we're yet in a position to report accurately and specifically on the second part, but I'll give it a shot, and if Tyson or Darcy wants to chime in, they're welcome to do so. The first part of your question, I think, was about employer retention, and the gist of it was, now I forgot that we've allowed you to do a two-part question, and now the floodgates are open, so who knows how long.
Yeah.
I imagine Richard texting me in the background somehow. But
you were giving me a hard time about the Super Bowl, so I figure I get a pass.
That's fair. I think in terms of employers, the truth is, and I think we commented on this a little bit in the third quarter call, we did extremely well. Our biggest source of attrition this year in HSAs, was the accounts that we were moving over, and we've talked about those in each quarter. There were another, 10 or 15,000 or whatever it was in this quarter, this last fourth quarter, but those numbers have trailed off as obviously as we've moved accounts over. Barring that, we had a very good year in terms of account attrition, and I think also from an employer perspective, as Ted talked about, one of the things that ultimately surprised me a little bit was the contribution to HSAs from new logos. We said throughout the year that winning new logos, particularly in the direct market, was going to be challenging in the context of the pandemic, but but the team really did a nice job with the wins that we got. We went for some big ones and won those, and that's the reason that those contributed so heavily to dollars transferred over in January, and obviously will be with us for a long time. So that's my sense of it. The last part of your question was about the percentage of our HSAs that are coming from partners versus direct. Obviously, our goal to some extent with the total solution strategy is to expand our direct and broker-enabled sales. It's a weird year to look at that in fiscal 21, given all that was going on. Our partners remain very strong, and as Ted commented, we started to see some notable wins from the retirement plan channel, even as we continue to kind of increase the foundational infrastructure there. So, but I feel like if I look at it and take a step back, there are 4 ways you can win business in here. You can sell direct to employers, you can sell through brokers, you can sell through in partnership with health plans, and you can sell in partnership with retirement. And in each of those areas, we saw good contributions this year from both existing and new partners. But obviously, it's a little bit tough with the pandemic, and we hung in there, and we think that puts us in a great position going forward.
Thanks, Greg.
Got it.
He's giving you the hook.
Yeah, apparently.
I get to blame him. This is fantastic. I wish this worked at home. Who's next?
Your next question is from Stephanie Davis from SVB Leerink.
Hey, guys. Congrats on
Hi
the
there.
numbers, and thank you for taking my question.
Was that your dogs in the background or no?
You know what? If you heard my dog barking, it is a very scary deep bark. So
Uh-oh.
I do not think it was mine. She's napping happily on the couch.
Outstanding.
Now, I have a quick question on the forward numbers because they seem so different from the positive takeaways on the metrics that you gave earlier on the call.
Yeah.
What is the driver of that implied guidance?
Yeah, I'll speak a little of this and then ask Tyson to detail it. I think the core is that we don't know, as you're well aware, we don't know how the coverage analysts and the like think about particularly the pandemic impacts on commuter and the like, and I think that's probably where the big delta is. But Tyson, you can provide some details on how we thought about those issues and kind of where the opportunities are going forward.
Yeah. Hey, Stephanie. Thanks for letting me have the opportunity to outline these. There's still those headwinds there. We really haven't seen improvement in commuter. And if someone knows better than my team about when that will come back and how that will work through the pandemic, I'd love to talk about it, but it just hasn't moved. And so, that's why we put the numbers in the script about where the run rate was and where we're actually landing, in this forward year. It'll be even lower than this last 21 year. And so that's an area that, it can, at the end of the day, we haven't included a lot in that forward model relative to commuter. In the second half of the year, there may be something as people come back to work. But that's really a big driver of that. When you think about the spend side of it, that's also something that I think we've been a little amazed about. I don't think that that's going to spike back. I think people are going to do that in a different way, and so we've been a little careful about that. I mean, the good news is there's a lot more assets that came in, and so that we'll do a couple of things. One, we placed it, and the other thing is that people will spend some of that, and so that'll help drive some of that. But we really haven't put anything in there that would really push that along. And then I think where the work actually has to happen and where we have to actually see how the team executes is in this FSA runoff and some of the change in the legislation. And that's really something that Ted and I have talked a lot about, and the whole team is about how to execute on that. We were out really early with our webinars on it. We got a lot of feedback from our partners and our employers about what they're going to do with plan design, but they actually have to follow through on that. So we'll see if we get something there as well. But again, not included in there. So those are the main assumptions that I think you'd be looking at. Of course, there's still interest rates in there that are lower than we want them to be, and those type of things.
Now, correct me if I'm wrong, but given the timing of your fiscal year, don't you really only have, let's call it, 2 months of tough comp on the commuter business? Or do you assume it's going to get markedly worse than what it was during the height of pandemic last year?
No, you're correct, and that's why we've really taken it down to the run rate over the last half of this fiscal 21 year into the next year. And you're correct, we had good results in February for commuter in March until things sort of lags the shutdown because people don't turn their cards off and pull away from it until that point. But you're exactly right.
The key point there is the timing, is that last point Tyson made, Stephanie. So I think as we talked about, if you go back to our script from the first quarter of last year, we saw some fall off really in April revenue for commuter. But even then, it wasn't as substantial as it ended up being for the full year, mostly because stuff kind of, folks, either they were wherever they were in the world still going to work, or they thought they would be, or what have you, or they just didn't get round to it one way or the other. But what we did is took where we were in the fourth quarter and extended that out. And I think that's, I feel like if from an investor's perspective, our job there is just to be clear about our thinking, and if we can do better, great. And we'll, by the way, I'm sure you'll be hearing about some things, we're going to try and do to accelerate that kind of that benefit as a whole and make it more relevant in the future workplace. But nonetheless, we wanted to be prudent about it.
Understood. I'll be hoping for some conservatism, so we're not spending a whole other year back at home. Thank you, guys.
Yeah, that would be ideal.
Stephanie.
Thanks, Stephanie.
Your next question is from Donald Hooker from KeyBank.
Hey, Don.
Hey, great. Good afternoon. So have so just on the topic of the yields, the guidance around the yield, cash yields on the HSAs, which sounds like, I guess, is a little bit lower than you had thought. Is there a way to think about sort of the incremental yield on that incremental deposit dollar? Because you're giving us sort of an aggregate yield. I think we're all trying to figure out where this thing's going to settle out at. Kind of what, I don't know if you're willing to share that or directionally kind of give us visibility, because there's sort of obviously a lagged effect. This will play out over a little bit of time beyond even this coming year. Can you give us a little bit of guidance on that?
I think maybe that's a good one for Darcy. You want to take this one?
Sure. And you're right, we don't give what individual placements are in specific contracts from a competitive standpoint. But the movement from what we guided in at JP Morgan conference was based on our range of estimate at the time. And if you'll recall, we estimated our cash would be between 9.6 and 9.7, 9.6 billion and 9.7 billion. We reported today 10.1 billion in cash. So however you want to calculate that, that's another $400 million or so. And so we have now placed that money, and it's at depressed rates right now. We will continue to ladder things out, Don, and so we're saying that our midpoint of our range before was in the between 175 and 180, was kind of in that 177, 178 range, which we were very comfortable with. And we're just taking it down to the lower end of that range because of that impact of the new money at a lower rate. Rates are very interesting to watch. I've watched them for 14 years now in trying to predict what our revenue will be. And yeah, we are kind of at a low end of that. And the good news is that we've got all 10 billion placed. And we rely on our depository relationships, and we have very strong, good relationships with all of our depositories. So we will be opportunistic as the year progresses. We'll see if rates firm up a little bit. Maybe you get a little bit of benefit there. But the most exciting thing is that we continue to grow. We can grow our cash assets and our investment assets. And so our yield, every quarter, we will give you our complete clarity view of what we believe our yields will be for the remainder of the year.
Okay. And then maybe I'll ask one follow-up and jump back in queue. You guys did reference that the COVID-19 outbreak, not surprisingly, caused some distractions among your network partners, and there were some deferrals. Can you give us any sort of incremental commentary around those deferrals, or you're going to get, kind of, I don't know if you're willing to, I don't know if it's possible to quantify them, or are these deferrals going to be recaptured in this fiscal year going into, so for fiscal 23, you'll sort of get a catch up? I'm just trying to sort of think through that based on the comments there.
Yeah, Ted, why don't you take this one? I interpret the question as basically being about the magnitude of our pipeline deferrals and what we're seeing so far early in fiscal 22 with regard to capturing that demand this year.
Sure. Thanks for the question. And we try to analyze this topic pretty diligently, but there's no sort of like league table for the number of RFPs that are out in the marketplace. So the way that we do it is we survey our big broker and consultant partners, and the vibe that we got was enterprise RFPs were down, depending on geography, depending on business line, significant sort of double-digit percentages kind of across all the people that we surveyed, which is an anecdote, not analysis, but just kind of gives you some anchor. And I think our experience in sort of supported that also anecdotally, which is that we started a bunch of cases that ended up getting deferred. I mentioned in my remarks that our closed sales through this point in the year are significantly higher than in previous years, and that's in large part due to cases that rolled over year by year. So we know where those deferrals are, we're working them diligently, and we're excited about their volume, and we expect it to be, that it'll be reflected in the opportunities that we have in this sales year. But to your point, the exact point, it's hard to get an exact analysis of how many opportunities got deferred industry-wide, how many did we get, what are the opportunities, et cetera. So the best we can do is kind of say that we're pretty optimistic about some of those cases that got deferred last year coming back this year.
Okay, well, thank you so much.
Thanks, Don.
Thanks, Don.
Your next question is from Sean Dodge from RBC Capital Markets.
Mr. Dodge, welcome.
Hi, good afternoon. I guess maybe not to belabor, but asking Don's earlier question is just a little bit different, just to make sure we're clear here. So around the sales outlook, I think this time last year you all said you had something like 136 RFPs from September 1 to January 31 that you'd received. We should think about that being kind of the metric here, and that being down, I guess, quote unquote, strong double digits. Am I interpreting that right?
If I understand your question, maybe a way to think about it is, and we can think about it in terms of RFPs or opportunities, and I should say in this regard, we're going to be in a better position to talk about opportunities, which is the right way to think about it, since especially in cross-sell, you don't go to RFPs. That's the whole idea. As the team has now, kind of completed, at least from a sales-facing perspective, the integration of our sales CRM systems and so forth. But I guess a way to think about it is simply as follows. Industry-wide, and this makes total sense, there was less, if it wasn't critical for you to do, you didn't do it. Right, so especially when you think about customers that were having to make those calls in the relatively early part of the year and into the summer, which would be your larger customers, right, where none of us really knew what was going on, and so that was reflected in aggregate RFP volume industry-wide. We actually did reasonably well, meaning we kind of roughly held serve in RFP volume, but then, as Ted mentioned, right, we saw a considerable amount of, okay, we started this process, but now we realize what it's going to take, and we got other stuff to do, are going to stall out. I commented in an earlier call that about a third of on the enterprise side, about a third of our RFPs actually ended up being deferrals that are into this year, and so our job is to go win those, and first to kind of get them restarted and then go win them, and we've done some of that already, and we'll keep doing it. But I think that's the broader picture is that certainly when it comes to this kind of stuff, wasn't a great year for switching activity, and yet we did okay. And in truth, the only thing that the only area of weakness that really shows up in the numbers on a year-over-year basis is actually not related to anything we're talking about now. It's related to the absence of new employees in the middle of the year, right? So meaning new, in other words, new employees, existing clients, where people come in and you have the opportunity to win that new guy plus the old guy can stick, maybe who he or she replaced, can stick around. And you can see that in the month-over-month data really clearly that up until about May, we were in really good shape, and that kind of is hiring that occurred in February and into March. So, first benefits months eligible might be April or May, and then, things kind of slow down, and then come November, December, they speed up again. Well, why? Because November, December, and January is when we see the benefits of open enrollment, meaning new clients and new open enrollment activity. So it's I think I guess the way I would summarize it is looking at our new client wins, looking at our accounts from new clients, et cetera. We did more than we at least held serve. Looking at assets, we did more than hold serve, including cash assets, not just market growth and all that. But where we were challenged, but that having been said, our goal wasn't to hold serve. Our goal was to do better based on the fact that we're rolling out this integrated solution and integration and total solution strategy. And I think what we're trying to communicate is we think that with a little bit of the dust settled, that we can get back to that pattern that we were on at the very beginning of last year, and really have a good year this year.
Okay, that's helpful. And then just a quick last one. I know the Personalized Care Act was reintroduced about a week ago. That I'd imagine would be a very nice tailwind for you all. And I get it's a tough question to ask or answer, but is there any particular insight or visibility or anything you're seeing, hearing that gives you some hope that something like that could move forward?
Yeah, Steve Neerlander, if you're back with us, I know Steve is quite literally trying to get Chick-fil-A people and turn them into folks and help them move people through vaccination sites. But Steve, if you're on, if you could comment on that, would be great.
Yeah. So we're following the legislation really, really closely, and the COBRA language was released literally about 57 minutes ago. I'm trying to use John's appropriate use of the word literal.
That is actually.
Was that? That's actual? So did I use it right or not? Anyway, okay. So it was actually released 57 minutes ago. And so we're just digging through it. It does look like that in the language from the chairman's version of this, and this is from the Labor Committee, that they're asking for 6 months of COVID relief at an 85% coverage level. And, there is some precedent with that. And, obviously the bill would need to be signed, and it would be 6 months after the enactment of the bill. And I think our team can comment on how we've even modeled that, which we haven't. But that's just being released now. There's some other provisions in there we think will come out of the amendments, and we're still waiting for other releases for the House Ways and Means Committee and things like that. And so, we think that's a great thing for Americans that are out of work. We estimate that it's between 2 and 3 million Americans that right now are out of work that previously had coverage. We know that there's more Americans that are out of work that did not have coverage before, that this might not apply to. And so we're tracking that closely, not only to help folks, and we're happy to help them get vaccinated, whatever we can do, honestly, but we're, in this case, help them get insurance and be able to continue making contributions to HSAs and things like that. And then, we're hopeful that there'll be some other things that come out of the bill. There was some language that went into the amendments around health savings accounts. We're not sure where that'll land. It'll probably come out. There was a bipartisan vote to maybe get some HSA expansion through this next reconciliation bill. But the devil's going to be the details. But we do think that there's a good opportunity as they start getting into amendments to get to our longer goal, which is to really tie the creation of an HSA to any credible ACA coverage. Anything that would be considered ACA credible coverage should have an HSA. We just think it's that simple. Most deductibles are a lot higher now than they were when the HSAs became law back in 2004, January 1 of 2004. So we think every American needs an HSA, and that is independent of whether they're in Medicare, Medicaid, TRICARE, regular commercial insurance. Everyone needs an HSA, and we're not going to rest until that happens. So I don't know if that answers your question, but this is evolving quickly, and we're following it closely, and we're pretty pleased that the COBRA stuff got in there, and now we're looking for HSA expansion.
Sounds great. No, that was a great answer. Thank you again.
If anyone can make a vaccination line, a drive-through vaccination run with the efficiency of a Chick-fil-A drive-through, it is Steve Nealman.
So come to Utah and get your vaccine, and we may give you a chicken sandwich too at the same time.
Your next question is from Sandy Draper from Truist Securities.
Hey, Sandy.
Hey, how are you doing, John?
Right.
This is probably less of a question, it's a clarification, so I've got it right in my head. So you said there are about 650,000 commuter accounts still suspended, and so based on Tyson's comments, you're not assuming any of those come back. And when I think about that in terms of revenue, pre-pandemic, there was $75 million of commuter benefit. You're expecting less than half of that this year, but that's even down from the fiscal year you just completed.
Correct.
Okay.
And that's because of the drag that was sort of the answer to Stephanie's question. Yes.
Got it. Okay, great. That's the first point. That's helpful. So the real question is, when you think about the sales, the opportunities, obviously there's some mid-year stuff that could happen that could potentially bring some accounts in. But when you think about how much better, as I go back to some, peak levels of fourth quarter sort of, signings, I'm just trying to get a sense for how big of an acceleration do you think you could see in new business wins? And I know you don't want to give a number, I'm not asking for that, but just, are we talking like a modest single-digit type improvement? You think you could do very strong double-digit improvement? Just trying to get some type of sense for, as things get hopefully back to normal, sales process gets better, you guys are used to selling in a virtual environment, clients are actually making decisions. If I look at it one way, if a third of decisions or whatever you said got deferred, could you even see a 30% increase? I'm just trying to get some way to think about this. Thanks,
yeah,
John.
I mean, I think we actually have come closer to giving you a number than ever before. So let me try and kind of round it out. Let's start with let me start with the CDB side and then go to the HSA side. Okay, on the CDB side, we actually opened nearly 1 million new CDBs this year. The trouble, as you know, is that we also got those 650,000 commuters in suspense, and then we've got a similar number, as I think one of us said in our remarks, of FSA folks who basically said, all right, I don't need this right now, and particularly on the dependent care side. So we actually had a pretty good sales year there, and I think in December and then even at JPM, we were feeling pretty good about that particular point, and so. And I think we can improve on it this year because, in a way, where you see cross sells there, they're easier. So the two opportunities there are, one is the stuff that's about bringing people back, and we'll have more to say about that over the course of the year. And then two is about, I think, repeating and refining the success on the sales side there. And so that's CDBs. I think on the HSA side, here's the way I'd put it: and this is a little bit where I was going in response to Don's question, is I think it's very easy to focus on and would probably be comfortable to say, well, the only difference between 724 last year and 680 whatever this year, 7, is employment, which, by the way, is true. That's great, but our goal wasn't 724, right? Our goal, pre-pandemic and all of that was to beat that number. And so that continues to be the case from my perspective, and continues to be doable from my perspective. I'm not going to presume we've done it, but but that continues to be the case. And the fact that, what's relevant about the sales cycle that just happened and the numbers, the area that really did exceed genuinely exceeded what we thought we would be on January 1st, right, between the 1st and 30th was that was people putting new deposits into the HSAs, but also the accounts we won, right? More of them were accounts that had already existed, and we were very successful at bringing those balances over. So what that means is that new sales are more immediately valuable to us. So that's kind of a good thing too for the long range of the business. And so those are the numbers that I would use to help you think about what we would like to get done this year.
Okay, great. That's really helpful. Thanks, John.
Yes, sir.
Thanks, Andy.
Your next question is from Alan Lutz from Bank of America. Your line is open.
Hey, thanks for taking the questions.
Yeah.
I guess the first one, just a clarification. You said 650,000 FSA members did not re-enroll in 2021. Is that correct?
Yeah, roughly. That particular number, that's the commuter number we know precisely. The FSA number's got a little bit of play in it because there is a lot of, for lack of a better term, fog of war around the delta between December and January as people are trying to understand this, temporary relief under the stimulus bill and so forth. But roughly, yes.
Okay, and then are they no longer paying a service fee? And then what's embedded in the guide for those people coming back, if at all? And then what do you think would need to happen for them to sign up? Is it possible intra-year, or is this something that would get pushed back to next year?
Tyson, why don't you speak to how we've thought about this for guidance purposes, and then maybe Ted, you can speak to some of the efforts that we're making with employers to create the opportunity for these folks to come back.
Yeah. I'd just say, Alan, the one thing is we're not including accounts in there that aren't deriving revenue. So if they're done driving revenue, then they're not there. If they're part of the carryover, then of course we have them in there as accounts. And then we haven't put a comeback in there. And that's what in my comments what I was referring to, and maybe I wasn't super clear, but that's the level of effort that we got to go through. And even just the legislation coming out and Ted and team figuring out a way to execute against that. We were out there early with the webinars, like I said, and we got a lot of good responses from folks, and it's a matter of working through and actually solidifying what they said. And you can't really rely on that until we actually see it happen.
And Ted, you want to speak to some of that and what the opportunity is?
Sure. Tyson's got it right. The answer in a nutshell is just outreach. It would be hard enough for me to explain every nuance of the opportunities that were in that 2,500 or 5,000 page bill that came out in January, much less somebody who's got 57 other things on his or her plate. So that's why we're in full-scale education mode, narrowcast and broadcast, webinars, outreach, et cetera. We've got, under Steve, we've got a whole kind of legislative affairs team that is, interacting directly with clients just to make sure they understand what their options are. And so, we're pretty bullish on our ability to impact behavior, especially because the legislation did pave the way for some pretty simple things that employers can do to help their employees take full advantage of their benefits. Our first big foray into that was just a few days after the legislation came out. We had to keep adding webinars because they kept hitting the 1,000-person maximum. And we put, an online form that basically said, hey, listen, you don't even need to call us. If you want to change your documentation, just tell us what you want on the form and we'll do it for you. And we've gotten, a couple thousand of those. So we're feeling pretty good about making ourselves available to help people and to push them down that path, both one-on-one and more broadcast. But as Tyson says, we didn't want to take that to the bank until we understood what it looked like and what the impact was. So we're continuing to execute every day on this, and we'll, hopefully we'll have, more insight every time we get this group together on what the potential revenue impact will be. But for right now, we're just trying to get people to make the right decisions for their team members and their employees, and we know that the economics will follow.
Great, thank you.
Thanks, Alan.
Your next question is from David Larson from BTIG. Your line is open.
Hey, David.
Hey, John. Thanks for taking the question here. With the commuter revenue, and I'm sorry to keep pushing on this, but with the $75 million pre-pandemic, you're expecting less than half of this in fiscal 22. Does that also include like the health card transaction revenue? And can you distinguish between how much is health card and how much is commuter?
Yeah, I'll give you the general answer, and then have Tyson elaborate. It does not. It's commuter fees and then commuter-related interchange, meaning commuter card. But Tyson, you can provide a little more detail if you'd like.
And the answer to the question too is yes, it does include that as well. And I'll give you a general guideline of that. I mean, the associated interchange is maybe 10% of that number, of the overall revenue number, something along those lines.
Yeah.
Okay, so
but health is its own. Health is its own world, and as Tyson said in his prepared remarks, I mean, we have assumed that we do get a gradual return to pre-pandemic levels of health spend, essentially drawing the line that we're already seeing there, or that we have seen over the course of fiscal 21, including December and January. We're not assuming fundamentally a change in commuter spend until the second half of the year, and they're very, very gradual.
Yep.
Okay, great, thanks. And then just one more. How is pricing? Like, it's my understanding that, like Fidelity, for example, they've got a very aggressive pricing strategy on the HSA side. I mean, any thoughts around that? I mean, and has it gotten more competitive with the pandemic, or is it sort of steady as you've always seen? Thanks.
Yeah, I'll take this one. I think the biggest thing that's happened in the last year that's impacted, two things that have happened that have impacted pricing. One, I think, favorable, and one, well, I think in a way, one favorable and one a little more challenging. First of all, the drop in interest rates and yields and the like has given everyone pause, I think appropriately so, as to how they think about HSA service fees in the long term. And while certainly, for larger accounts, there's plenty of competition there, it's probably fair to say that in some respect, for new business, for your typical account, that's maybe a little bit less intense because you can't underwrite balances that don't exist, and you can't underwrite, balances at interest rates and the like that don't exist. I think the second factor, though, is that by going to a total solution strategy, we've kind of changed the way that we and I think others in the industry are thinking about this, and that the way that you get, but certainly the way we're thinking about it, that you get, the way to get discount on service fees from us is to buy total solution from us, right? So what we're able to tell clients in the field, whether they're renewing or new clients, is we'd love to give you a lower price. The way to do that is to, you're doing COBRA, do it with us. You're doing, you've got a flexible spending account program for people who aren't in your HSAs and for your dependent care, do that with us. Now, did that yield a ton of fruit this year? I mean, obviously, it certainly yielded some, and will yield more going forward. I think that's a better answer ultimately than just underwriting interest rates, and will serve us better in the long term. So, that's kind of how I think about it. I think, well, I guess I'll just stop there and see if that was helpful, and if you want to add anything onto it.
That's very helpful. It sounds to me like with all the different products that you have from the wage acquisition, if your clients can buy a full portfolio of solutions from you, that's how they can improve their price point. And that's really your go-to-market strategy. And that's
and I think that's the right way to approach it from our perspective. And certainly, there are other competitors and who are going to play that game too, and that's okay. But there are a lot of competitors who can't play that game, and so they're going to be really, I think Tyson talked about this on our last call, that you've got competitors who are heavily interest rate dependent, and I think we're much more challenged in this regard over the last year.
Thanks very much.
Thanks, David.
Your next question is from Mark Marcon from Baird.
Good afternoon, and thanks for taking my question.
Yes, sir.
Couple of questions. One, you mentioned that you ended up getting, some pretty big new logo wins this year that you weren't fully expecting. Who did you end up winning from? What were the key reasons, the key drivers? That's the first question. And then the second question is basically on medical plan design. Among your key employers that are out there, what's your sense in terms of to what degree they're going to tilt away from high deductible healthcare benefits? Sometimes that shifts from year to year. Just wondering with the employment environment being what it is, how that ends up shifting this year.
Yeah, I'll try the first one, and then at this point in the year, it's a little bit of a stab at the second one. On the first point, I have to say this is an area where in really difficult positions, I'm really, really proud of our enterprise team and their ability to get significant new logos. And I can tell you, in every one of these cases, all the companies that you think of as our would-be competitors, Fidelity, United, obviously HSA Bank, the three that people think about as from a market share perspective, but others also, are involved. And what we were able to do successfully this year, I think, was the following. First, we were, I think, very successful. And I'm really just focused on the enterprise cases where you really know what's going on and you know all the gory details. I really feel like the company was very successful at positioning the fact that we are focused on helping everybody build health savings. We are not just out there for the single individual who we hope has a rollover IRA out there that could be $2 million. None of our members have $2 million in their HSAs. Okay, and yet we try to serve every member really well. And I think that came, it's not just a service issue, it's fundamentally, what are those other members doing? And the answer, of course, is they're trying to understand their health care bills, they're trying to understand how this stuff works, they're trying to understand how to think about, pricing and so forth when it comes to, like, I've never talked to a doctor about a bill before. Some of them are, early in the year, and a lot of these decisions are ones that were made, I think in retrospect, were kind of sort of made that a switch was needed in the height of the pandemic when you had people going to their employers and saying, "Wait a minute, I have a deductible and it's not huge, but like I don't have $2,000 sitting around. Like, what do I do?" And we have answers for those. And by the way, those answers will get better over time. But we actually think about that. Whereas I think very candidly, some of our competitors either think about this as some sort of gateway drug to rollover of IRAs or whatever, or think about it as more of a banking product, and it's neither of those things. So I think that was quite helpful. And then the second thing I want to say is I think are also just kind of closing my eyes and thinking about these cases. Our partnerships on both the health and retirement side were extremely helpful here. Even if we didn't end up selling with partner, if client was doing business with partner, we worked together, and it showed that we are a company that will play nice in the sandbox. We're not trying to build our own edifice here, and that's the way this company has always operated. And I think that showed very well at a point where clients were not looking for new problems, if that makes any sense. So we had our biggest win ever from a retirement plan partner, but we also had cases where people were working with different partners of ours, and even if we didn't end up selling through that contract or whatever, it was just extremely helpful in terms of conveying what Purple is about and what we're trying to do. The fact that we were ready and we had created relationships that enabled us to work with, let's say you had 3 health plans and one of them was our partner and 2 of them weren't. We were ready to work with all 3 really well. And our partner conveyed that we were ready to do that, and that was very, very helpful. So I feel like I guess my first answer is ultimately that we try to meet everyone where they are in their healthcare journey. And then my second answer really is we try to do that with everyone who's a part of, as an employer, of your ecosystem rather than imposing our ecosystem on you.
That's great. And then any stab at the health plan design?
I thought you'd forget that one. No. How do I just kept talking? I mean, admittedly, yeah, it is only. Now, I should say I should be giving everyone as hard a time as we give Craig. But on the second question, which is about plan design, I mean, the way you asked the question, the premise was that perhaps the default was tilting away. I just don't see that in the data. What I see in the data is that every year the component of health plan design that is about consumer cost share goes up. And sometimes it goes up a little and sometimes it goes up a lot. I think the biggest challenge we have in that regard is that not everyone is eligible to participate in HSA particularly because, as you know, right, folks still like to use copay as opposed to coinsurance, that kind of thing. And that's what Steve's talking about when he says that any ACA creditable coverage should really be HSA eligible. That's where we should get to, so that I mean, we're at a point where people's deductibles, and this is why companies like a Good RX or the like can prosper, because their co-payments are actually higher than the negotiated price of the drug, right? And that's fine. That's a plan design element, and maybe it makes sense because they have certainty and they don't have to use Good RX. That's fine. Those people should still be eligible to save for health care and retirement and to spend less on health care now. And so I think that the broad trend that is the consumer is part of the solution, not part of the problem, right, is happening and will continue to happen year after year after year. I'm absolutely certain of it, right? Whether in good economic times and bad, right? But the specifics, I think we have to get better at. We have to educate both our legislators and regulators and so forth that this has got to become easier for consumers. And transparency is a piece of that puzzle, obviously, too. That's my thought on it. Is I think I do think there was probably a little bit of a pause on all of this last year, just in the sense that there was a pause for change, period, right? But the logic of engaging the consumer in the process of trying to spend, make every healthcare dollar efficient is pretty irrefutable. It's damn good logic, and it can be taken to extremes. And I think some of those extremes, our view is that legislators and others should work on, and I'm sure they will. But I think within the mainstream, it just makes a ton of sense, and that's why you're seeing it year after year.
Great,
Thanks,
thank you very much.
See, you got the hook, just like Greg there. That's Richard blowing the whistle.
We are an hour. We are past the hour that we're supposed to go. But we do have one more question. So
it's that good. The content is that good.
It's that good.
Your last question is from George Hill from Deutsche Bank.
Hey, George.
Hey, guys. Hey, Purple. I can't promise that the last question will be that good because just about everything I was thinking of has been asked. I guess, John, I would just throw at you. Are you seeing anything on the regulatory horizon which causes you any concern, anything about surprise billing or about the way that the government wants to make consumer drug deductibles at the point of care more palatable? Again, I'm generally seeing most of these things as kind of positive as they would allow balances to bill, but would just love you to comment on anything you're seeing on the regulatory side that you think can cause a concern.
I really like what I'm seeing thus far out of the way that this transition team has sort of thought about this. I mean, I don't want to get crosswise with anyone, but look, as I was saying in the answer to the last question, I think we should look at these, what I would call super high deductible policies. Can an average person manage a $12,000 deductible in the ACA exchanges? I don't think so. And I mean that doesn't seem great. So I think we should be looking at that. I think, similarly, I absolutely love that action was taken on surprise billing. Is it perfect? No, right? But I mean, to be colloquial for a second, surprise billing is bullshit. First of all, it's a bullshit name. It's not a surprise to anyone who understands the healthcare system. It's out-of-network billing, and the fact that that's now not something people have to worry about is another reason for them to engage with the healthcare system rather than just be scared about it. So I really like that, and I'd like to see this administration continue. I mean, not as well, I'll say it this way, that even with a group you may not like, they had a few good ideas, and one of them is the transparency rules and interoperability rules that would both create some incremental transparency, which is good, but also give consumers more control of their data. So I think those are pretty good things, and our job though is to encourage both the Congress and the administration to think about those in terms of how they support the average working consumer. They have much more knowledge about what goes on in the ACA exchanges or in Medicaid or in Medicare than they actually do about the voluntary, employer-sponsored market that insures 230-odd million Americans. And so that's the job that we have to keep doing. And I think Steve and Jody and the team have done a really good job of kind of getting started with that over the course of the last few years, but that's going to help us succeed.
John, as always, great color. I appreciate it. Thank you.
Yes, sir.
Thanks, George.
Thanks.
I'm showing no further question at this time. I would like to turn the call over back to CEO, Mr. John Kessler, for any additional or closing remarks.
Yeah, thanks everyone for sticking with us. We will, in addition to being on the conference circuit, as you can see from our releases, we will be in the middle of March, I suppose, to talk about Q4 earnings and as Tyson mentioned, to give a little more color on how we see fiscal 22 going. Until then, thanks a lot.
Ladies and gentlemen, this concludes today's conference call. Thank you for your participation and have a wonderful day.